Good morning and welcome to the Forward Partners Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand you over to CEO Nick Brisbourne. Good morning, sir.
Good morning. In fact, Jake, thank you. Welcome, everybody. Thank you for your interest in Forward Partners. We're here to present our interim results, which tell the story of strong underlying portfolio growth, but we are suffering from some valuation headwinds. But before we get into the detail, some quick intros. So I'm Nick Brisbourne, CEO, founder of Forward Partners. Been running Forward Partners for 9 years now, and prior to founding Forward, I was a founding partner at Molten Ventures, one of the other leading listed VCs, and have a long career in venture before that, tracking back to 1999. With me, I've got Lloyd Smith, Cfo, and Luke Smith, our leading investment partner. Hand over to Lloyd for his intro now.
Hi, my name's Lloyd Smith. I'm the CFO of Forward Partners. I trained early on in my career at EY in audit. I then moved into a deals team, mainly a restructuring environment where you have to manage cash and advise businesses on the optimal use of that. And after my time at PwC, I found myself in a technology startup and grew that from $1 million to close to 100 million turnover now. And I think that's really great experience to have as the CFO at Forward Partners and investing in technology companies.
Hi, I'm Luke Smith. I'm the investment partner at Forward, where I lead the ventures team. I've been with Forward for 6 years now. Before that, I was an investor at REV Venture Partners, a corporate VC, and I started my career at Oliver Wyman doing strategy consultancy. And originally, I did a PhD in biochemistry at the University of Cambridge.
Thank you both. So who are we at Forward Partners? Well, we're an early stage sector-focused venture capital firm, and we're structured as an investment company. So that means that the management company is internalized within the fund. So all of us, and the reason that's important is that all of our stakeholders, all of us, our shareholders are aligned as owners in a single company. That's different to a traditional GPLP structure that you see in the private venture markets. So what do we do? We invest in early stage UK venture, pre-seed and seed stage, and we operate a sector-focused strategy. So our sectors historically have been applied AI, marketplaces, and e-commerce. And then over the last 6 months or so, we have started to orient our new investments away from e-commerce. And so we still do applied AI, still do marketplaces, but less e-commerce going forward, and more of a focus on Web3. But the existing portfolio, that comprises predominantly applied AI, e-commerce, and marketplace businesses. So for us, one of our core beliefs actually is that venture capital is a services business. It's a slightly strange service because part of it is cash. It's also strange because we say no to the vast majority of customers that would like to work with us, but the best entrepreneurs have a choice. And so we need to understand ourselves as providing a service to them, and as well as capital and great help from the board. The key part of our service, our USP, unique selling point, is that we run an agency on behalf of our portfolio companies. We run that on a not-for-profit basis. That's called the Forward Studio, and largely focused on talent now, where there's a real dysfunction in the provision of recruitment services to early stage tech companies, and so we're adding some real value there. And finally, if you've been following Forward Partners for a while, then you might have noticed that in previous iterations of this slide, when we presented our results previously, we also mentioned Forward Advances. That's no longer here, as we took the difficult decision actually, a month ago, to move Forward Advances into wind down. So turning to our results now, I'll leave it to Lloyd to take you through the detail, but the the message I'd like you to take away is that the decline in the fair value of the ventures portfolio, that isn't the cause for concern that it might appear to be. And the reason for that is that the valuation declines are largely on paper, and the underlying portfolio companies remain in very good shape. And so long as they continue to perform, and we believe that they will, then valuations will start rising again. Lloyd?
As you can see, thank you, Nick, the venture portfolio value there is 94.9 million as of June 2022. And that is down by a fair value decline of 28 million since the year-end reported number. And there are really three things driving the valuations there. The first factor is rounds are taking longer to close for our portfolio companies. So what does that mean? It means that they're not testing the price in the market with other investors, and we haven't got that latest, most recent information where it's been market tested. So companies then move into different valuation methodologies such as comparables. And when we look at public, so the second factor then is looking at the public comparables. When we look at technology stocks in the publicly traded market, they are substantially down on what they have been historically. So those comparatives comparing to our portfolio companies reduce the valuations there. And then the third factor is liquidation preferences. So liquidation preferences tend to benefit later stage companies. So they put their money in. If they don't achieve a certain value, they will get their money out first. And so that has a greater impact on the earlier stage investors like ourselves. However, we're not looking to sell these companies anytime soon at these lower valuations. So what does that mean? As valuations start to improve and the comparables start to improve in public markets, the liquidation preferences will unwind in Forward's favour. When we look at the cash, we have 22.6 million of cash on our balance sheet at June 2022, and that equates to 17 pence per share. So that's more than enough cash to support the current portfolio, and it looks like good value when you're comparing it to the 85 pence per share of the net asset value we currently hold as of June.
Thank you, Lloyd. And the strength of the Forward Partners balance sheet is an important asset for us at this time. So some highlights from the portfolio, and when we look at the portfolio, there's a couple of things which continue to give us real confidence that we're going to get great returns. So the first is that the exit theses for our leading companies all remain intact. So at Forward, we're all about investing in companies that can be the leaders in emerging new markets. And when we look at some of our strongest businesses, the most valuable ones by fair value, companies like Gravity Sketch, like Spoke, like Ably, they are well positioned now to come through this difficult period ahead, stronger, leaner, and crucially still leaders in their market. And it's that market leadership position which really drives value on exit. And then the second thing that we look at when we are assessing actually really the health of our overall business is, do we have enough shots on goal in order to give us the small number of outside successes which drive success, which will drive the returns that we want to provide to our investors and generate for ourselves. And as you probably know, in venture capital, success comes from having a very small number of outside successes. And the good news is that when we look at our shots on goal, they're pretty much the same as they were 6 and 12 months ago. So the companies that we thought could provide those outside successes in the past, they're still looking strong, even though the markets have got more difficult. So why is that? What's happened over the last period that gives us the confidence that our portfolio really is in good shape? Well, the first thing is that we've had really good levels of fundraising. So as you can see here, 14 companies overall have raised, of which 8 are in our top 15, so over half of our top 15 companies by fair value. And that hasn't happened by accident. When things started to get difficult in sort of around the end of Q1, we sat down with the CEOs and all of our leading portfolio companies and helped them think through how they needed to change their plans for the time ahead. So often that went reducing their pace of investment, reducing their headcount growth plans. Sometimes it meant cutting costs. Sometimes it meant fundraising, and when they did need to fundraise, of course, we supported them in that. Now, we only ever put money into our portfolio companies, make follow-on investments into our portfolio companies when they've got a good chance of providing significant cash back to forward partners on exit, an amount of cash which is material in the context of our balance sheet. And so all of the 12 companies actually which we put money into in the first half are over that threshold. But what we also like to see is when we invest, other investors come in alongside us as well. And happy to say that was the case in every one of the 12 follow-on investments that we made in the first half. And very often investors are coming in for a multiple of the amount of cash that we put in. So, for example, Spoke, the men's clothing brand in which we're invested, they raised 5 million, and our contribution to that was £250,000. So we get a lot of leverage. So all that fundraising has resulted in our portfolio companies having strong balance sheets. As you can read on this slide, over 80% of the top 15 by fair value have either 18 months plus cash runway, are profitable, or on a path to profitability without a further raise. And that that really helps protect our downside. So our exposure to down rounds, to bankruptcies is manageable, definitely. And then finally, turning to the right-hand column here, finally for this slide, the confidence in the long-term growth of our portfolio, and getting back to valuation growth, comes from the underlying revenue growth. So as you can see here, we're forecasting 40 to 60% growth for our top 15 over the course of this year. Hopefully that's a conservative forecast. The growth rate in the first half was actually over 100%. And that's important because revenue growth is the biggest driver by far of valuation growth for early stage technology companies. So that's why we have confidence in the portfolio, but it is undoubtedly a tough market right now. You can see that in our share price, and that hurts us obviously. But as I've been telling the team, what you do in times like this is that you make sure that you are appropriately resourced, then you put your tin hat on, you ignore the noise, and you get back to doing your work. You get back to doing good work. Then when things improve, you come out stronger. And it's the strength in our portfolio. That's what gives us confidence that that is a good strategy for us at Forward Partners. Really, it's the strength in our portfolio. That's the rock on which our business is built. So turning now to the case for early stage investment. Our portfolio is in good shape, as I've been saying, and I think there are two real reasons for that. Firstly, we've executed well, but also we operate within an attractive market. There are significant tailwinds that have been supporting early stage venture for some time now, and they're going to continue. And those tailwinds, they don't change with recession, they don't change with high interest rates or with war in Ukraine. And the most important of those tailwinds, the most important driver of growth in the venture capital ecosystem is the ever-increasing pace of change. And as change happens faster and faster, that drives innovation from large companies to startups. And why does that happen? It happens because speed creates advantage. It creates the potential to serve your customers better. It creates the potential to generate more profit. And hence this ever-increasing pace of change, that's embedded into the heart of capitalism itself, and it's a trend that isn't going anywhere anytime soon. So then within venture capital, it's at the earliest stages where you get the most rapid revenue growth and therefore get the most rapid valuation growth. That's why we like the earliest stages. And you can see that in the chart on the left. Then turning to the chart on the right, we see how valuations change over the cycle. And the summary here is that volatility in valuations is much greater at the later stages than it is at the earlier stages. Now, it's hard to give precise numbers when doing this analysis because at the early stages, when we're valuing businesses, we do so on a range of intangibles, putative future market size, quality of team, quality of product. And so when you're comparing valuations from one period to the next, you're never able to know for sure if you're really comparing apples with apples. However, with that caveat, our estimate is that the valuations have dropped, and it's patchy or uneven, but our estimate is that valuations have dropped 20 to 30% at the earlier stages, and that compares with 50% or so at the later stages. And whilst it's really hard to know at the early stages, at the later stages you can be a bit more precise with the valuation drop, because there you have more consistent valuation metrics, generally revenue multiples. So I share all that because there's a natural read across from the decline in late stage valuations, including those of listed tech stocks, to early stage valuations. Natural read across to assume that our portfolio will suffer the same declines as been seen at the later stages, but we just don't think that's the case. When we look at things bottom up, we just don't think that will be the case. One of the kind of lens to look at that through is that as valuations were going up over the last couple of years, then they went up to a much greater extent, much higher percentage at the later stages than they did at the earlier stages. So as things come back down, you can expect that earlier stage valuations will drop less than later stage valuations. And after all of this change, there's still plenty of upside to go after. So whereas previously, like a year ago, we might have been investing at 10 million and hoping to exit at 500 million to $1 billion. Now we might be investing at 8 million and hoping to exit at 250 to 500 million, and with less dilution along the way. So still great returns to be had in the market as it's adjusting. So where does that leave us? In early stage venture, if you're able to predict which markets are going to grow to be big, and able to predict which companies are going to be the leaders in those markets, both things we've shown ourselves able to do here at Forward, then you've got an opportunity for significant value creation, and that's an opportunity which transcends the economic cycle. On this slide, I'm going to give an overview of our investment model. So the first thing to note is that we see a lot of deals. So over 4,000 a year. And our first job at Forward, my first job when I founded Forward 9 years ago, was to make sure that we were seeing enough deals. And what you need to do is make sure you're seeing enough to get coverage of the market and comprehensively know what's going on, see all of the major trends that are occurring. And for us, we think that's about 4,000 deals per year. And once you get over that volume, the emphasis shifts from needing more deals to really focusing on quality. And that's because leads take time to process. So after you get to a point, simply finding more leads doesn't bring you much extra insight. And so now all of our initiatives, all of our deal flow initiatives are focused on lower volume, high quality initiatives. So a good example of that is the Funding Lab program we ran a few months ago. And there we did a little online competition. We selected the best 12 companies from that applied to go through a series of workshops that we ran, helping them grow their businesses, prepare for fundraising. And then we took the best of those, top 3 in fact, to the first meeting. And so that was a very focused, high quality deal flow initiative. So we get the 4,000 plus in at the top of the funnel, and the next stage is to triage. So we meet roughly the best 10%, then we get serious with about 1% of those, and we invest in 0.1 to 0.2%. So that's 4 to 8 of the 4,000 plus that we see. How do we get from 4,000 plus to the 4 to 8? We run a structured process employing a range of frameworks to assess the team, the product, and the market. And those frameworks, many of them proprietary. For example, we use a framework to assess team, which goes by the acronym KIDDLE, Competence, Insight, Drive, and Leadership. That's a proprietary one. So these frameworks, they're key to driving consistency and quality through our decision-making process. And they're also the vehicle through which we're constantly iterating these frameworks to make them better. That's the vehicle by which we embed continual improvement into our investment decision-making. So investing in 4 to 8 deals per year, that leads us to it leads to a carefully sized portfolio with enough companies to give us the successes we need, given our hit rate, but small enough at the same time that we can really manage it effectively. And then turning to the fourth column here, the final bit, of course, is to manage those companies through to exit. And the trick there is being careful to really focus our efforts where they're going to move the needle for our eventual outcomes. And the biggest thing there is being ready to cut our losses on our losers quickly. And so in practice, what we do is we always spend a lot of time with founders and CEOs in the first year or two after we invest. And then after that, we're only spending more time if the company can deliver great returns to us. And in those scenarios, sometimes the company is raising big additional rounds like Gravity Sketch, like Ably, and then we are to a reasonable extent handing the mantle over to later stage investors. Sometimes we retain higher stakes and much more active in managing it through to exit ourselves. Makers is a good example of that. And then we stay very close all the way through to exit. Okay, now I'll hand over to Luke to explain how that model's been working in practice over the last period.
Thank you, Nick. So yeah, deal flow's been strong in the first half of the year. We're really pleased with it. We've seen 2.2 thousand opportunities in the first 6 months, and that's roughly flat on last year. And as Nick mentioned, that's basically our target. We're not really trying to grow the top of the funnel now. We're seeing enough. We are actually taking a slightly higher proportion of meetings than we have historically so far this year. And there are two main reasons for that. One is that with the new focus on Web3, there's more benefit in taking more meetings and actually having the learning opportunities of interacting with the entrepreneurs and seeing what is happening at the cutting edge. So we've been taking that and deliberately taking a higher proportion of meetings. The other is that with the uncertainty in the market and the volatility, again, that rewards just being close. And so we've deliberately chosen to have a higher proportion of meetings for the extra information that provides. And we think that's the right decision. One thing we are seeing in the market is there's less competition. And that's coming from two main sources. One is that the other seed stage funds, it just seems like they're a bit less active. So there's a little bit less competition from them. And another that is noticeable is that the later stage funds, which had started to do pre-seed and seed rounds last year, as the competition further up the rounds got more intense, that's really pulled back now. So we're just seeing less of that. And so that has a few impacts on us. The first is that rounds are just taking longer to close. We're not seeing the very, very short time to get a round done that was happening last year. And that means we have more time for diligence. We can make sure that this is an investment we really want to be doing through the frameworks that Nick's mentioned. It also means we're winning a higher proportion of deals. So, the deals we're wanting to do, we're able to win this year, which is obviously a good thing for us. And the other is that we are seeing that valuations are more reasonable than they have been in the past year, 18 months. And so we're able to get in at more attractive entry valuations. So all three of those are favorable to us. We've done 2 deals so far this year and really excited to tell you about them in a couple of slides. We also have enough in the late stages of the pipeline that we're confident of hitting our 4 to 8 deal target for the year. And you can see we've invested 4.9 million in the existing portfolio so far this year. And as Nick had mentioned, we typically invest alongside other investors. Other people share our conviction. These are companies that have the potential to drive high returns. And so that 4.9 million actually unlocked more than 30 million for our portfolio companies. And that's partially why the balance sheet strength is so high, as Nick mentioned. And we're proud of our portfolio. We think it's strong. You can see we have a slight lean towards B2B over B2C, and that actually is strengthening over time with the focus on applied AI. We're seeing more opportunities in the B2B space than the B2B. So that's likely to continue to some extent, although we're not going to move away entirely from B2C. And then, when we're looking at the shots on goal, we're really excited by them. You can see Gravity Sketch there. That's a leading platform for 3D design and collaboration. And that's really exciting at the moment. If you saw the news about Figma, which has agreed to be acquired by Adobe for $20 billion. Now, to my mind, that was Adobe realizing that building design tools with collaboration as a core functionality is just so difficult that it's worth paying for it. And now Gravity Sketch is the leading 3D design tool with collaboration built in natively. And 3D design is the next big frontier for design. So I think that makes Gravity Sketch really exciting as a potential property. You can also see there Robin AI, which automates repetitive legal processes using AI. They grew revenues 10x last year, in a really strong place, raised money from Google's Black Founders Fund, one of only 30 founders to do so, and have continued growth so far this year. So another really exciting one. And then we have Ably, which is the leading real-time platform for bringing live and collaborative experiences at scale. So their customers include companies like HubSpot. And, in terms of scale, they reach hundreds of millions of devices a month across 80 countries. So really big. And they raised $70 million from Insight and Dawn last year. And I mentioned the two investments made so far this year. So we have Baseline, which was a pre-seed company we invested in alongside Sequoia's ARC Accelerator, which focuses on founders who have the potential to be real outliers. And Baseline plays into serverless infrastructure, which is a big and rapidly growing paradigm within software development, which basically enables developers to not have to worry about the infrastructure they're building on top of. So they can build more quickly, more scalably, and at lower cost. So it's a significant improvement on existing approaches, but it has a problem, which is observability. And basically, when you move to serverless, you go from having a single application stack to having potentially dozens of different components that have to interact. And that means if there's a problem, it's very hard to identify where that problem is and fix it. And if this is powering your e-commerce website, every minute where you're not fixing this is a minute when you're losing money. And so Baseline is built natively for serverless to solve that observability problem. The founder is deeply technical and has lived this problem and built solutions for it in the past. And it has the potential to be a big enabler for serverless technology. So we're really excited by it. Sunrise, very different business. That's an analytics platform in the healthcare space. So it enables multiple types of healthcare information, imaging, pathology, clinical notes to be combined and analyzed for drug discovery and for precision medicine. Precision medicine is a really exciting emerging trend. And again, Sunrise has the potential to be a key enabler there. And I've been investing in digital health since before I was at Ford at my last fund. And what made me particularly excited about Sunrise is it's just very rare to see a seed stage digital health business with real commercial traction where the product's been validated by paying customers. And Sunrise had really strong commercial traction. And it's since we've been speaking to them, signing new customers, growing revenues. And so a really exciting opportunity. And in both these cases, we haven't taken on a lot of follow-on funding risk. So we're aware that the markets are volatile and later stages, it's not easy to fundraise right now. And so, we try to minimize that where possible. And Baseline, it's a pre-seed company, a very small team, limited burn. So they have the potential to keep burn low while they iterate on product, find product market fit and start scaling. So they can choose to scale when they're ready, rather than having to go out and raise soon to continue their journey. And on Sunrise, as I mentioned, they've had strong commercial traction and they can ramp that without massively ramping costs, which positions them well to move towards profitability and be under their own power, rather than having to raise again within 12 months and being at the whim of the market. So yeah, we're excited about both companies.
Thank you, Luke. If we see the graph to the left here, You can see the portfolio value as of the year end being bridged with the interim portfolio value at June. And so the 28 million fair value decline is there in the middle, which we previously discussed. And then the realization there is a 0.5 million for Somo. And really that's reduced the portfolio value, but it's actually money we've received in cash. The 6.3 million, that's the total of the 4.9 million follow-on investments and the 1.4 million invested in Baseline and Sonorai. And that's what the graph on the right is showing. It's showing the steady decline of funds being deployed throughout the year. And we're consistently able to meet those follow-on requirements as and when is necessary and do our new deals as required by the investment team. And that's because we've got a strong cash on the balance sheet able to support our investments. And then we turn to the next slide. What this slide is trying to demonstrate is when we put money into an investment, we're able to grow its value. As you can see, the green being the money going in and the blues being the fair value increase. There are a couple of instances where the money going into the investment has reduced the value. However, we're not exiting those positions at any time soon, so they have every opportunity to grow the valuation again. And we look here at Gravity Sketch, which Luke has already described as leading the way, followed by Spoke and Koyo Loans.
Thank you, Lloyd. So I want to finish now by bringing together a number of the themes that we've talked about so far on this presentation, but with a focus on what that means for the future. So firstly, venture remains an attractive asset class, a very attractive asset class in our opinion. As I said, the ever-increasing pace of change is a really powerful tailwind, and that's what makes venture capital a long-term game, and hence we shouldn't be over-influenced by short-term valuation declines. Then in the medium term, revenue growth at our portfolio companies is going to drive strong valuation growth for forward partners. And as we've seen, our portfolio continues to grow well, even as the markets get difficult. And moreover, once they're able to raise money again, then they'll be able to increase their rate of investment and that pace of growth will increase. However, in the short term, valuation headwinds may lead to a further decline in the fair value of our portfolio. We are seeing increasing signs that it may not be long before we get back to growth, although I have to say events of the last couple of weeks, especially the last week, have muddied the picture again. But on the turning to a more positive, our downside is well protected here. Because our portfolio company balance sheets are strong, then we aren't too worried about down rounds or bankruptcies. And hence, if we do see valuation drops, they are primarily going to be as a result of our own internal valuation process rather than any third-party valuation events. And turning to building for the future. So as Lucas said, we continue to see great deal flow and make great investments in what will be our next generation of, excuse me. And what will be our next generation of shots on goal. And this is a time to be mindful of valuations. It's a time to be mindful of next round financing risks. So we are proceeding with caution, but we do feel very excited about the deals that we're getting done now. This current crop really could turn out to be one of our best vintages. And then finally, perhaps most importantly, actually, the forward partners balance sheet is also strong. We have sufficient cash to support our portfolio and continue our investment rate for the foreseeable future. And that puts us in a great position to weather the storm ahead and wait for the strength of our portfolio to shine through. Okay, thank you. Now we will go to Q&A.
Nick, that's great. And Luke and Lloyd as well. Thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Nick, as you can see, we have received a number of questions throughout today's presentation. So thank you to all of those on the call for taking the time to submit their questions. And if I could just hand back to you to run through the Q&A tab to respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you, Jake. So the first question is, how actively involved are you with the investments and the exit strategy to recycle funds? So I'll take that first one. So the answer is very active. It's impossible to attribute accurately, but when you talk with VCs in general, we feel that maybe half to 2/3 of the value that we create comes from our initial investment decision, and 1/3 to a half therefore comes from the work we do with our portfolio companies after having invested. And so we remain very actively involved with our portfolio companies, helping them to grow, helping them think through their exit strategy, helping them to prepare for exit, generally 1, 2, 3 years before the exit actually comes. And so we do all that from the board. And then in addition, as I mentioned at the top of this presentation, we uniquely support our companies operationally through the Forward Studio. So the next question here from Matthew. Thank you, Matthew. And I'm going to hand this one to you, I think, Luke. So is the current market bringing more opportunities? And of the 20% of the portfolio that's not profitable, what visibility in the funding requirements do you have to take them to profitability?
Thank you, Matthew. So in terms of the current market bringing more opportunities, as I mentioned, we're seeing good deal flow. So I think yes, and particularly we're seeing less competition, which means we have more ability to win the deals we want to win. So I think yes, we are seeing a slightly higher ability to win the opportunities we want to win, and yes, better opportunities. In terms of the portfolio, so to be clear, it's 20% of the top 15 by fair value that are not profitable or have less than 18 months of runway. So it's not that they're all profitable. Some that have 18 months or more of runway. Yes, we typically we have a board seat there. If not, we have a relationship with the founder. So we have good visibility of what the cash requirements they have, and we're supporting them with that, helping them to figure out who the right investors are to be speaking to, how they need to position the business to raise from follow-on investors, where they need to be cutting costs to extend the runway, and where an internal round from the existing investor base, which would include us, makes sense to extend the runway further. So, we're very active in that. We have been continuously, but it's been a big focus over the past few quarters, given where the market is.
Thanks, Luke. The other thing I'd say is that the vast bulk of that remaining 20% are in active fundraising discussions right now. Okay, next question is also from Matthew. Investing early stage is highly risky. How do you manage this process and diversify what happens when the investments don't work out? So let's split the question into two. I'll take the first bit, which is how do I diversify and what happens when investments don't work out? And then I'll hand to you to talk through the process of the investment decision, Luke. So how do we diversify? So we've been in venture capital for a long time now. We know what our hit rate is, and it's about 15% of our investments become runaway successes. And so we make sure that we've got a large enough portfolio that if 15% turn out to be runaway successes, then we will generate the returns that we need to generate. And so that's what I was saying, when we create a carefully sized portfolio, big enough to give us the right number of shots on goal ultimately. And then what happens when investments don't work out? Then the kind of at the highest level, we stop investing, and then it's down to the CEO and the team there to work out what they do. Some get themselves to profitability and kind of subsist at a low level, and we may get a small amount of cash back one day. Others engage in some kind of fire sale, and then sometimes businesses go under. and that's part of the model, right? We're early stage investors. We expect a significant portion of our 50% of our portfolio, actually 50% of our investments, not to make a meaningful return. But then that 15% that drive the real results. The important thing is getting that 15% right. Luke, you want to talk through the decision-making process a little bit?
Yeah, sure. So we have a rigorous process to decide which investments to make. As Nick mentioned, we use a number of frameworks, and the areas we're evaluating are the founder or the founding team, really getting a sense of their strength, but not just their strength, but their fit for this particular opportunity, because different opportunities need different strengths in a founder. And I think that's important to understand. We also look at the product and the pain point they're solving. So we've gotten good at evaluating, what's a real pain point and what does a good product that's solving that pain point look like. So, we use frameworks like jobs to be done. We're also looking at market size, both top down and bottom up, to come to an accurate as possible view of how big the opportunity would be. And that's really important in venture capital, because as Nick said, ultimately what really matters is getting that 15% of runaway winners. And to do that, you need to be playing in big markets. And it's particularly difficult at the early stages because often these markets are growing very fast or emerging. So it's not necessarily just a case of pointing to big existing markets. The other areas we're looking at very closely are things like go-to-market, pipeline momentum. So looking across all the factors of a business to make sure it fits with something that has the potential to be a real outsized success. And then also, particularly at the moment, layering on a view of how much capital will be required and whether there is follow-on funding available for this kind of business. So taking into account not only the strength of the business, but the funding landscape and the kind of path the business will have to follow to be able to get each next round away, to make sure that we're minimizing the risk of the company not succeeding, but also particularly that this company has the potential to be an outsized winner.
Thank you, Luke. And then turning to our final question here. So how much of an impact are the current macroeconomic headwinds having on your decision to make new investments compared to follow-on investments? So what we did earlier this year, which is what we've always done when the markets turn and things get difficult. So we did it when the pandemic came and did it in previous funds back in 2008 and 99, or 2000 rather. So what we always do is you sit down, you look at the portfolio, you work out which companies you want to be supporting, you work out how much money they might need, you work out where they might get that capital, so which other investors do they have, which could support them alongside forward? Will they be able to raise new investment? And out of that analysis comes a figure which we will need to, cash requirement from forward to support our portfolio. So we did that this year, and we looked at that, and the figure that came out of that was £6-7 million, and that is in line with anyway what we've been planning to invest this year in the portfolio, and left us with therefore we're investing about 10 million a year. So that left us then with 3 to 4 million to invest in to make new investments, which is that's enough to do 4 or 5 deals. So consistent with our investment pace over time, albeit at the lower end of the 4 to 8 range that I mentioned earlier. So net, we're able to support our portfolio and able to continue our investment rate for the foreseeable future, as Lloyd said earlier. Okay, thank you.
Nick, thank you very much, and Lloyd and Luke as well. Thank you for addressing all of those questions that came in from investors today. And of course, if there are any further questions that come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. Nick, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you, Jake, and please do provide us with your feedback. So looking forward, venture capital, as I've said, venture capital is a great market to be in. We have a strong portfolio. These are difficult times that we're living in, but the period of difficulty is going to be relatively short compared to the long periods when returns in the venture ecosystem have been great. So we remain very excited by Forward and hope that if you're not with us on our journey already, then you will join us soon. Thank you.
Nick, that's great. And Lloyd and Luke as well, once again, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Forward Partners PLC, we would like to thank you for attending today's presentation, and that now concludes today's session. So thank you.